Hi, I'm Ken with Global View Investment Advisors. As we celebrate our Independence Day, many investors are asking if they should invest outside of the U.S. There's plenty to worry about around the world. The Brexit brings this to mind. The problem with thinking this way is that valuations already reflect this thinking. You see, right now the U.S. market represents over half of the total world stock market. The U.S. also represents less than 1/5 of the world economy, according to the CIA. In fact, Europe and China have larger economies than ours, but smaller stock markets. So an enterprising investor should ask, does this make sense? Well, it happened because of these fears. Over the last 5 years, investors bid up the prices of the biggest, priciest U.S. stocks while ignoring many outside of the U.S. This has happened before. In 1991, when everyone feared Japan was taking over the world, Japan rose to almost half of the world stock market. In 2000, the U.S. stock market again became half. We all know how this played out both times. And I'm not suggesting that the U.S. market will crash, but I'm suggesting investors need to think differently. The best indicator of long-term stock returns is valuation. Based on this metric, the one that we favor, the Shiller PE, the U.S. is by far the most expensive in the world. Today's valuations in fact suggest that over the next 5 to 10 years, U.S. stocks may only return 1 to 3% per year. International stocks may return 8 to 10%, and emerging market stocks are likely to do much better. While the short-term returns of these stocks can be volatile, this volatility represents opportunity for enterprising investors. Unfortunately, for most investors, volatility means risk, which is manifest when investors sell. In fact, over the last 15 years, investors in the largest fund in the world, the Vanguard S&P 500 fund, retail investors in this fund made 3.2% per year. This happened because they became fearful and sold during the last 2 bear markets. Most investors have over 90% of their risk budget allocated to U.S. stocks. 1/3 of this is in index funds, and we estimate most of the remaining 2/3 is in closet index funds that look substantially like the indexes in terms of risk. Investors aren't likely to do well in these. Based on this massive disparity in valuations, we will not ignore our own country. We just believe we have to be very careful, looking for wide moats, reasonable growth, and decent valuations. We've developed a stock portfolio we call Great Businesses designed to be lower risk. This portfolio is performing nicely, and we're working with Morningstar to learn if we can extend it globally. But we also believe that with 85% of the economy outside of the U.S., it makes sense to put half of your risk budget there. If you're not already a client, we would like the opportunity to show you the level of risk you're taking in your 401k or the other investments and present alternatives. To learn more about how we find quality cheap stocks in the U.S. and overseas, drop me a line at ken@globalviewinv.com or contact us through our website. Thank you for your time today.